Have you noticed the strange alignment happening across the markets? It's not about sudden dramatic price swings, but something slower, more deliberate, and much more significant. A quiet convergence of currencies, commodities, and certain risk assets that's becoming impossible to ignore. What's really fascinating isn't the speed of the changes, but the direction capital is flowing, and more importantly, where it's not flowing. Let's dig into what this means, because the implications are huge. First, let's talk about precious metals. Just a few quarters ago, the prices we're seeing today for gold and silver would have seemed unbelievable. Silver has completely broken out of its multi-year trading range, showing incredible strength. Meanwhile, gold has been on a tear, hitting one record high after another. It's not just precious metals either. Other real assets priced in US dollars, like energy and certain industrial commodities, are also feeling sustained upward pressure. This isn't a story about all fiat currencies collapsing at once. Instead, we're seeing concentrated stress within specific financial systems, particularly those tied to the US dollar. While the dollar is still the king of global trade, it's showing clear signs of weakness against other major currencies. This is happening at a time of significant fiscal uncertainty in the US, with rising government borrowing needs and growing concerns about the long-term sustainability of its debt. This isn't a new phenomenon. History shows us that when a dominant reserve currency weakens under these conditions, commodities priced in that currency tend to go up. It's almost a mechanical process. Think of it this way. As the dollar loses purchasing power, you need more dollars to buy the same amount of a real asset, like gold or oil. This pushes their nominal prices higher. For foreign buyers, their stronger currencies make these dollar-denominated assets cheaper, increasing their demand. For those holding dollars, buying real assets becomes a way to protect their wealth from being eroded by inflation. We've seen this dynamic play out time and time again, and the current market data is showing us the same pattern today. This is where precious metals play a truly unique role. Gold and silver are special because they wear multiple hats. They are monetary assets, seen as a store of value for millennia. They are financial assets that you can trade on global markets. And they are also essential industrial inputs, used in everything from electronics to solar panels. This diverse demand structure is one part of the equation. The other part is supply. You can't just print more gold or silver. Supply is tightly constrained by how long it takes to find and develop new mines, the massive capital investment required, and the simple geological fact that they are rare. So when demand suddenly accelerates, as it seems to be doing now, supply can't keep up in the short term. The immediate price adjustments happen in the financial markets, through inventories and futures contracts, long before any new production can actually hit the market. This supply and demand imbalance is a powerful catalyst for the price action we're currently witnessing. So what is the broader market telling us? The convergence we're seeing isn't just a random set of price movements. It suggests a fundamental repricing of risk and value is underway. Investors are looking for safety and a reliable store of wealth in an environment of currency debasement and fiscal instability. The flow of capital into hard assets like precious metals and key commodities is a direct response to the perceived erosion of purchasing power in the US dollar. It's a defensive move, a flight to tangible value. This isn't just about the US dollar, though. It's about the very structure of the global monetary system. For decades, the world has operated on a dollar-centric model. But the strains are starting to show. The sustained rise in gold against all major currencies, not just the dollar, indicates a broader loss of confidence in fiat money itself. Central banks around the world have been accumulating gold at a record pace, diversifying their reserves away from the dollar. This is a clear signal from the world's largest financial institutions that they see a shift coming. They are preparing for a future where the US dollar may not hold the same undisputed position it has for the last 50 years. This isn't a forecast of doom and gloom. It's an observation of a major ongoing trend. The markets are a forward-looking mechanism, and right now, they are pricing in a future with greater monetary uncertainty and a higher value placed on real, tangible assets. The gradual, yet persistent nature of these moves is what makes them so compelling. This isn't a short-term panic, it's a long-term structural shift. The alignment of gold, silver, energy, and other commodities points to a deep and growing concern about the future of paper currencies and sovereign debt. As an investor, or even just an observer, understanding these dynamics is crucial. We're not just watching numbers on a screen, we're watching a global rebalancing of economic power and a reevaluation of what constitutes real money and a true store of value. The signals are getting louder. The question is, are we paying attention? The flow of capital is telling a story of caution, preparation, and a search for stability in an increasingly unstable world. Paying attention to these flows, to the quiet but powerful currents moving beneath the surface of the market, could be one of the most important things we do to navigate the financial landscape ahead. Thanks for watching. If you found this analysis insightful, be sure to like, subscribe, and hit that notification bell so you don't miss our next video. We'd love to hear your thoughts in the comments below. See you next time. Hello and welcome back to the channel. Today, we're diving deep into a fascinating divergence in the financial markets. The powerful rally in precious metals versus the surprisingly quiet performance of certain major digital assets. It's a puzzle that's got a lot of people talking, so let's break it down. For months, we've been in a classic environment for hard assets to shine. Think geopolitical uncertainty, stubborn inflation, and questions about the future of global currencies. As expected, gold and silver have been on a tear, hitting multi-year highs and capturing headlines. But what about the assets often called digital gold? Interestingly, some of the most liquid digital currencies haven't quite followed the same script. Instead of acting purely as a hedge against currency debasement, their price action has looked more like other risk assets, like tech stocks. So, what gives? Why are these two supposed safe havens on such different paths right now? This isn't actually the first time we've seen this happen during major economic shifts. The key to understanding this divergence lies in one crucial and often misunderstood concept: the difference between liquidity and safety. When financial conditions get tight or uncertainty spikes, big investment funds and institutions need cash, and they need it fast. They might be facing margin calls, investor redemptions, or simply need to reduce their overall risk. In these moments, where do they go to raise that cash? They go to the markets that are always open, have tons of buyers and sellers, and where they can sell large amounts without moving the price too much. Highly liquid digital assets fit this description perfectly. They trade 24/7, globally, with incredible efficiency. So even if a fund manager is still bullish on a digital asset for the long term, it might be the first thing they sell simply because it's the easiest and fastest way to get cash. It's a source of liquidity. Think of it like this. The asset that's easiest to sell isn't always the one you want to get rid of the most, but under pressure, it's often the first to go. It's a tactical move for short-term balance sheet management, not necessarily a fundamental change in belief. Now, let's contrast that with physical precious metals like gold and silver. When someone buys physical gold, they're usually not thinking about selling it next week. It's a long-term strategy. They buy it, they store it securely in a vault, and it sits there, often for years or even decades. It's much harder and slower to mobilize physical metal to meet a sudden cash need. You can't just click a button and have the funds in your account in seconds. Because of this, the available supply of physical metal for trading can actually get tighter as prices rise. People are holding on, which just adds more fuel to the fire, without attracting the same kind of short-term speculative selling we see elsewhere. This brings us to the technical picture. Systematic trading algorithms, momentum funds that chase trends, and even industrial users who need silver for manufacturing all jump in at the same time. This rush of simultaneous buying can cause prices to accelerate very quickly. Gold's journey has been a bit different. It's been more of a steady, grinding climb higher, punctuated by brief periods of consolidation. These actions can create temporary pullbacks or pauses, but they don't necessarily change the underlying long-term structural uptrend that's in place. To put this all into perspective, let's look at market capitalization. It's not a perfect comparison, but it helps illustrate where the money is flowing. Recently, the total value of above-ground gold and silver has started to rival or even exceed the total value of some of the largest digital asset networks. Again, the structures are different, but these numbers give us a clue. They show that in the current environment, a significant amount of capital is being selectively reallocated. Investors are making distinct choices. Precious metals are reasserting their traditional role as a long-term store of value and a hedge against systemic risk held with a long-time horizon. Meanwhile, highly liquid digital assets are proving their incredible utility as a source of immediate 24/7 liquidity, making them useful for tactical trading and cash management, but also susceptible to selling pressure during times of market stress. It's not a story of one being good and the other bad. It's a story of different tools for different jobs in a very complex economic machine. Understanding this distinction is absolutely critical for navigating the markets today and in the future. As the global economic landscape continues to shift, watching how capital flows between these different asset classes will give us some of the most valuable insights into what is really going on under the surface. It's a fascinating time to be an investor. Thanks for watching today. If you found this breakdown helpful, be sure to hit that like button and subscribe for more deep dives into the markets. Let me know your thoughts in the comments below. See you in the next video. Have you ever looked at the market and felt like the old rules just don't apply anymore? 1 month, tech stocks are soaring. The next, everyone's talking about gold and silver. It's easy to get whiplashed, but what if I told you this isn't random chaos? It's a sign of something much bigger happening beneath the surface. Today, we're going to decode what's really driving the money flows between traditional assets, precious metals, and digital currencies. And by the end of this video, you'll have a much clearer framework for understanding this new financial landscape. So let's start with what we're seeing right now. There's been a noticeable shift in investor preference. It's not a complete abandonment of stocks or bonds, but rather a selective and careful reallocation of capital. Money seems to be moving towards assets that feel more tangible, more direct, and less dependent on the whims of policymakers. Think about it like this. If you're building a chain, you want the fewest possible links that could break. Investors are looking for those shorter, stronger chains. This brings us to silver, which is a fascinating and often misunderstood asset. Silver lives a double life. On one hand, it's been used as money for thousands of years, a store of value just like gold. But on the other hand, it's a critical industrial metal. A huge chunk of the silver mined each year goes directly into manufacturing. It's in your phone, your computer, in solar panels, and even in specialized chemical reactions. This dual role creates a really interesting dynamic. When silver prices go up, you might think industrial users would cut back, right? Find a cheaper alternative? Well, it's not that simple. For many of these applications, the amount of silver used is tiny, but its properties are irreplaceable. So even if the price doubles, the overall cost impact on the final product, like a smartphone, is negligible. The manufacturer will just pay the higher price because they have to. This makes industrial demand for silver very sticky, or what economists call inelastic. But here's the kicker, the supply side. You'd assume that if prices are high, miners will just dig up more silver. The problem is, most silver isn't found in dedicated silver mines. Over 70% of it is a byproduct of mining for other metals, like copper, lead, and zinc. So the decision to open or close a mine is based on the price of copper, not silver. This means silver supply doesn't react quickly to its own price signals. So you have sticky industrial demand on one side and an unresponsive supply on the other. What happens when demand outstrips new supply? The market has to dip into the world's stockpiles, the above-ground inventories. These are the big vaults of silver bars held by exchanges and investors. For years, these stockpiles have been acting as a buffer, smoothing out the difference, but those inventories have been steadily declining. As they get lower and lower, there's less of a cushion. Any small imbalance between supply and demand can lead to much bigger, more dramatic price swings. We're getting closer to a point where that buffer is gone, and that's when things could get very interesting for the silver price. Now, let's shift to its shinier cousin gold. Gold's story is a bit different. Its industrial use is much smaller. Gold's primary role is monetary. It's the ultimate safe haven asset. For the past several years, the biggest buyers of gold haven't been individuals like you and me, but central banks around the world. Countries are stocking up on gold, and they're often very open about why. Diversification. They want to reduce their reliance on a single currency, like the US dollar, and hold an asset that isn't someone else's liability. However, central bankers aren't naive. They don't just buy gold at any price. When prices get very high, their buying tends to slow down. They might wait for a pullback or a period of consolidation before they start accumulating again. So even with this strong structural buying from central banks, the gold market can still have periods where it trades sideways or even dips. This doesn't mean the long-term trend is broken. It's just the natural ebb and flow of a market where even the biggest players are price sensitive. Understanding this helps explain why gold doesn't just go up in a straight line, even when the reasons to own it seem stronger than ever. And then we have the new kid on the block, digital assets like Bitcoin. These operate on a completely different set of rules. Their supply isn't determined by geology and mining equipment. It's controlled by code and algorithms. We know exactly how many Bitcoin will ever exist, and we know the rate at which new ones are created. This programmatic scarcity is one of its main attractions. Furthermore, when you trade gold, you're often trading a paper contract, and final settlement means moving physical bars, which is slow and cumbersome. With digital assets, settlement happens on the network, a distributed ledger that is fast, global, and operates 24/7. These features, like portability and speed, are huge advantages. but they also come with their own unique dependencies. The whole system relies on the integrity of the network, the security of the code, and access to electricity and the internet. Because these assets are still relatively new and are just beginning to be integrated into the mainstream financial system, they behave differently, especially during times of stress. Their volatility is much higher. They're like a small boat in a big ocean. They feel the waves a lot more than the giant aircraft carriers like gold or the US Treasury market. As institutions like pension funds and corporations slowly start to allocate capital to this space, the character of the asset will change. But for now, it remains a high volatility player driven by its own unique set of factors. So, what's the common thread tying all of this together? It's one word: uncertainty. The global financial system is built on a mountain of debt. Monetary policies are constantly changing, and the geopolitical map is being redrawn right before our eyes. These powerful forces have shaken the very foundations of how we traditionally value assets. The old anchors we used to rely on are dragging. In this kind of environment, every investor, from the individual to the largest institution, is forced to ask fundamental questions. What is truly safe? Where can I find liquidity when I need it most? What will best preserve my purchasing power over the long term? The answers to these questions aren't found in news headlines or expert declarations. They're found in the flow of money. We see the answers when we watch capital move from one asset class to another, and when we see inventories of physical commodities get drawn down. The current trend shows a clear preference for physical, tangible assets with limited supply. But will this last? It's impossible to say for sure. It could continue, it could level off, or it could reverse if global conditions change. The key is to understand the interplay of all these forces: currency dynamics, real-world supply constraints, the need for quick liquidity, and the slow, deliberate moves of large institutions. We're living through a major market transition. It's a period of re-evaluation and rediscovery. The best way to navigate it isn't by looking for definitive black and white answers, but by understanding the forces at play and thinking in terms of possibilities. The story is still unfolding, and by watching the flows, we can read the chapters as they are being written. Thank you so much for joining me today to explore these complex topics. If you found this breakdown helpful, please hit that like button and subscribe to the channel for more deep dives into the forces shaping our financial world. I'd love to hear your thoughts in the comments below. What are you seeing in the markets? Until next time.